Welcome back, folks. This is teaching number 8 of a series of 8 for the month of November 2016, ICT Mentorship. We're going to be talking about false tops and bottom patterns as it relates to classical head and shoulders. Now, a head and shoulders pattern is typically seen with a price high that trades in a small little retracement, and then it creates a higher high, and then it retraces back lower, and then it creates another lower price peak or short-term high, and then connecting those 3 successive peaks in price, we classically refer to that as the neckline. And classical support resistance ideas are seen here, where if that neckline is broken, many times you'll see it retrace or pull back up to that neckline and then sell off again. In the form of selecting targets, you can measure the range from the neckline up to the head or the highest peak, and subtract that range from the neckline once price breaks below it, and that'll give you a reasonable price objective. Now, the problem with this pattern, okay, it's because it's taught in all of our retail books and such. Every trader out there, when they first get into their charts, they're always looking for these types of patterns, but generally price will form these genuinely at intermediate or long-term highs only. And due to the low understanding of most retail traders, they tend to seek these classic topping patterns on lower time frames, and many times at a significant low in price, but they marry the pattern. The opposite is referred to as an inverted head and shoulders pattern, and this is a false bottom pattern we're going to be teaching in here. So we're not really teaching these classical patterns. They can be found on the internet. I'm not going to teach that, but what I'm actually going to tell you is how you can capitalize on these patterns when they appear in charts and our higher time frame premise indicates the opposite direction is unfolding. But an inverted head and shoulders pattern is typically seen with a short-term low that's met with a lower low, then it makes a higher short-term low, and you connect the highs that form around those 3 successive lower lows, and we refer to that as the neckline. Eventually, should price trade above that neckline, classically you would expect a pullback in price or retracement back down to the neckline, and then an advancement up to the target. And the range from the neckline down to the lowest low of those 3 lows added to the neckline once the price breaks through it, that would give you a reasonable upside objective. Now again, much in the same way, generally price will form these genuinely at intermediate or long-term lows. And again, much like we said with the regular classical head and shoulders pattern, due to the low understanding of most retail traders, they go into the lower time frames and they start looking for this classic bottom pattern on lower time frame charts, and many times at a significant high in price. But much like you probably have done when you first started as a trader, you get these textbooks and you get these ideas and you go in, you force the understanding of what you learned out of the books into the charts. So therefore, you learned about a head and shoulders pattern, so therefore there must be a head and shoulders pattern right now, so let's go in there and trade it. And unfortunately, it doesn't always equate to profitability. When I first started as a futures trader, this was one of the patterns that were really promoted hard because it's the idea that you want to catch a high and you want to catch a bottom. And picking tops and bottoms is one of the worst games to play, especially as a new trader, because number one, even seasoned pros don't do that. Okay, we don't pick tops and bottoms. We can trade with rather impressive accuracy and catching significant intermediate term lows and short term lows and highs, but as it relates to long term tops and bottoms, I try to avoid that, and I actually promote the idea of doing the same thing in your own trading. Try not to do that. But one of the coolest things I've learned by going through institutional order flow studies and watching how interbank pricing is delivered, it allows me to go in and actually see these patterns when they form in price charts. If I have a indication that the price is actually going to go higher, and I see a head and shoulders pattern, which would be a false top, in my opinion, but in the charts, retail will see that as a top forming. Conversely, looking at an inverted head and shoulders, which would be classically viewed as a bullish pattern in price, if I see that happening when the market is actually bearish, I would be looking to go short. And where we see the neckline, let's go back to the standard head and shoulders pattern. When you look at the neckline, what I see there is an opportunity to be long once the neckline is broken on the downside, especially if we are in a institutionally framed bullish environment. That means if we're in a long-term or intermediate term low and it forms a successive 3 peaks in price moving higher, which would be classically viewed as a head and shoulders pattern, pure chartists would see that as a bearish indication, especially newbie traders or less informed traders. I like seeing when price does that because to me it's a retail trap, and market makers are actually designing classical chart patterns in price where you can actually get tripped up thinking just because you saw a head and shoulders formation and the neckline is broken. When that neckline is broken, I don't see that pullback as a resuming lower or a new selling scenario. I see that as a turtle soup long that took out 2 previous lows where the clean lows were there. I look at that as a buying opportunity. So I'll buy the sell stops below those equal lows or where the neckline is, and then I'll look for the head or the highest peak to be violated, and I'll try to pair up my long exits with the buy stops above the highest high in this pattern. And that would be my first objective. The inverted head and shoulders, I would do the opposite. If I'm looking for price action to be bearish, as a higher time frame would indicate, and I see a low with a lower low and a higher low, which would be deemed as a inverted head and shoulders, I don't see that as a bullish breakout above the neckline. I'm actually looking at that as a run on buy stops. And I'm going to look to go short there and not expect to see price go higher, but in fact blow out those equal highs and then make a run for the sell stops below what would be deemed as the head on this pattern, or would be the lowest low in most recent price action. You can actually take your first profit at the right shoulder on both these patterns, respectively. But let's take a look at a couple of chart examples, and you can see what this pattern looks like in price. Okay, folks, we're looking at a daily chart of the British Pound USD, or cable. And I want you to take a look at this down candle right before the up move. We've consolidated for a while. Price came down and hit that same order block right here. Okay, it closed in the fair value gap between the high to the midway point of the candle, and look at this candle right next to it. Price came down and respected that range. Okay, right in here, didn't go any further than that. And then on this day here, it's August 10th, we traded through the down candle, making this a bullish order block right in here. So from this candle's high down to its opening, it becomes sensitive to be a buyer. Right there. And the high comes in at 155.46. So on this day here, we trade down into it on the 12th of August 2015. Trade right down into the body of that down candle, which is a bullish order block. Now that's bullish on a daily. So let's take a look at an hourly chart at that same time on August 12th. So here we have the market making a high, a higher high, and a lower high, and we have 2 equal lows in here. So we have what? We have a head and shoulders pattern. Retail traders are going to see that as a selling scenario. So they're going to look for a break of this neckline and then take the range from the high down to that neckline and subtract that, and that'll give them their objective for going short. Okay, so we have that range here, and we can duplicate that and give ourselves our downside objective for the retail-minded crowd. So retail is going to think this breakdown here is going to lead them down to 155 or thereabouts in this range here. So retail is going to expect a range expansion down to a low of 154.95. We do not expect that because on the daily chart we're expecting the bullish order block to send prices higher. So while we see a regular head and shoulders pattern, which would be classical bearishness in a part of price action study, as it relates to institutional order flow, we're looking at the run below these lows in here as a run on sell stops. So we're looking at the market to go below here to pair up orders to go long for those individuals that want to have a sell stop down here that's already long. Their trailing stop loss is going to be in the form of a sell stop because the market move most recently has been higher. We see this move below these equal lows as an opportunity to buy those sell stops. Those willing sell stops or flood the market when the market trades below here. So now we have a lot of liquidity. Remember that market efficiency paradigm. We see liquidity here in the form of going long. And we're going to be looking for objective up here to take profits. So we could be a buyer at 155.50 and look for 56.20, a move above this high, 56.20 as our objective, or 70 pips. The market runs 1, 2, 3, 4 more times below that low, gathering up the sell stops, and then expansion to pairs up the buy stops above 56.20. And ultimately, you can see a nice little pullback here. Okay, so that's an objective of using the head and shoulders pattern against what retail would expect and using higher time frame institutional order flow on the daily chart, reading it as the banks would. Let's go back out to that daily chart. You can see what it did as a result. And there's that expansion. And it's not much of a move, but that you don't need much of a move when you understand what you're looking for. Okay, we have another example here. This is the daily of the British pound USDs. The down candle right before this big move up, equal highs in here. There would have been buy stops above these highs. This rally up takes out those buy stops, and it comes all the way up and closes in its range all up here. So this liquidity void's closed in. Last up candle closes it in. But more importantly, these stops were targeted with this down candle. That means that this down candle was a bullish order block, which is used to break the buy stops that were in the marketplace here. So when price trades below it here, when price comes back up to it here, we're inside of a breaker. That's a bearish environment. 153.45 to 153.50 in that area, we're looking for a reason to expect some kind of a bearishness. But there's going to be, on the lower time frame, retail will see patterns like this. We have a low, a lower low, a higher low. This is an inverted head and shoulders pattern. You draw your neckline on the chart. Okay, that's the high up here. And we're going to draw what would be considered the inverted head and shoulders neckline, connecting these two levels here. And the difference would be from the low up to this neckline. Once we break above it, price trades above it here. Neckline's broken. The stops below here would be targeted. So selling up here on a break above the neckline, not looking at that as bullishness in return for higher prices, but looking for it to sell off, getting above there. So we would look for that run to sell into the buy stops above this high here and above this high here. That's why we would expect to see some bearishness here. And then we would wait for a run below these lows here. It does give a lot more than that here, but nonetheless, it's not a bad little trade. 10, 20, 30, 40, 50, 60, 70, 80 pips or more running them low over here. Let's go back out to the daily. Okay, and we're going to look up at this high up here. Price trades up into it here. We're going to use the low of the last up candle right here and the body of the candle. You can see that it trades up into that as well. And we're going to look up at the 18th on October. Okay, so we have, here's the 15th, creating a head and shoulders inverted, so that would be viewed as bullishness. So if we get above that high, we can be a seller because we would expect those buy stops to be viewed as breakout artists in inverted head and shoulders. They're going to see that as a bullish pattern. We're going to look at it as a bearish pattern. We're going to be completely opposite of that. Now you can do two things. You can use this here, or you can use the bodies of the candles like I teach, where the most volume is. So this is the highest body of the candle. So 5502 would be a sell if we get above it. Price trades to it here, so you can be a seller above 5502. So 5502 is your area being bearish. We do not look at that as a breakout and then wait for a pullback for new higher prices. We're looking to see it sell off, and there's your entry on the buy stops at 5502, and the neckline, I'm sorry, the head down here, your objective would be to cover below that low right here, and that happens right there. And then again, all through here gives you another opportunity to cover, and ultimately runs one more time above that 5502 level for buy stops, and then again below what would be the head. Plenty of opportunity to make handsome profits. So again, it's you look for the pattern because retail will look for the pattern, but you're going to fade that pattern based on what you see on the higher time frames. We look for institutional order flow to justify why this should be bearish up in here. We should be looking for reasons to be selling, not buying. And if we see inverted head and shoulders patterns on the lower time frames, retail is going to be all over that looking for bullish, upside moves. And that's not what you see here at all. So hopefully you found this one insightful as well. We're going to be attacking a lot of the retail-minded classical chart patterns throughout this ICT mentorship. So this is just the beginning of 2 that will fall victim to institutional order flow. Until next time, wish you good luck and good trading.